Welcome to this session. So in this session, the main objective of this session is to discuss the problem of conflict of interest in finance markets. So we are going to discuss what are the areas where we can see conflict of interest in the finance market, and because of that, in which way, how does the issue of conflict of interest adversely affect the efficient working of finance market. So one of the features that we have seen in financial system is that the existence of many number of financial institutions. Financial institutions are prevalent in finance market mainly because they have expertise in interpreting signals and collecting information, right. This we have discussed in length in one of the previous sessions. We can also see that they have been providing multiple services in the market. So this includes, for example, because of providing multiple services, that is collecting, producing and distributing information. So look, for example, banks. You know that banks they collect information and they produce this information, and to some information they distribute as well. Similarly, rating agencies, you know that they also collect lots of information about the financial market or different firms, different stakeholders, and then they distribute this information. So because of that, when they collect, produce and distributing information, sometimes they have economies of scale. They often enjoy economies of scale, that is the volume of their activity is actually provide incentive for them into make to engage more and more further the different types of different types of financial activities, including all these. The low cost of information production, it often leads to economies of scope as well. So that means because of economies of scope, we will discuss both this concept in detail. Because of low cost of information production leads to economies of scope as well. Actually, you know that most there is nothing new, but actually the economic institution, that the financial institution, just like any other firms, they try to maximize profit. So while trying to maximize profit, they often rely on this economies of scale. They also make use of economies of scope in order to maximize their profit. And in this, during the maximization of profit, they offer this process leads to conflict of interest. This actually adversely would adversely affect the financial system, adversely affect the financial system. So before proceeding further, let us see what is the concept called this economies of scale and economies of scope. So starting with, first of all, economies means it's all about cost effectiveness. Then economies of scale means it's all about the benefits gained by the production of large volume of a product. So when you keep producing large volume of product, mass production, then the per unit cost, that the marginal cost of production decreases very fast. It diminishes at a faster rate. That is one. Then about the economies of scope, that means instead of economies of scale, we talk about the volume. Economies of scope means is linked to the diversity, that means variety. You can see that is linked to the benefits gained by producing a wide variety of product by efficiently utilizing the same operation. So coming to the first part, the economies of scale, it occurs when a firm gain efficiencies from producing a wider variety of products. That is the economies of scope, a wider variety of products. That means it make it cheaper to produce a range of products together than to produce each one of them on its own. Often this is the case when the business own a lot of enterprises. So for example, you can see that a bank, suppose a large bank, that is their bank, for the bank is one of their business, right. So in the case of bank, you know that they, because of the bank, they have the large several branches across the country, and they have the strong economic and managerial technical capacities they are having. So because of that, you can also see that banks will be starting insurance business. They will be, the same bank will be entering insurance industry as well. You know why? Because they already have all this expertise. For example, the infrastructure, the premises they are having across the country, so they have the wide network, and because of that it is easier for them to start an insurance firm as well. And you know that because the this bank, you know that they will be having large number of customers, so it will be easy for them to sell insurance product to them as well. So you can look at, for example, State Bank of India. State Bank of India also has the insurance, right? Life insurance they are having, SBI life insurance they are having. In addition, what they will do that, since they have access to lots of information, the same bank also will start some research. They will engage in research. That means they will do consulting. So because initially the research, it will be helping them, it will be helping their insurance industry, and it will be helping their banking industry activities. The research will be helping them, and for them to do the research, they will be getting data from this bank and insurance as well. Plus, you know that they have been making use of the online facilities, online banking facilities, online insurance facilities. Most of the online facilities, it will also facilitate from them from research, help them to do better research, and they can also actually, some of the software businesses also they will acquire, because they think that maybe another service they will do, that the software business they will be engaging, because you know that all these are actually mutually connected, they are mutually syncing. So because of that, they will be having multiple business. So this is actually called diversity or variety. This is nothing but economies of scope. So this is called economies of scope, and what we are going to see that because of economies of scope, sometimes often it leads to conflict of interest. It often leads to conflict of interest that actually going to affect the working of financial system. Economies of scale, which I forgot to mention. So economies of scale is actually means the defined as a change in output for a given change in inputs. So you can see that when they produce large number of goods, the quantity, when they keep on increasing the quantity, and obviously you know that their cost of production will decline. So for example, look at, for example, a mobile phone production. Maybe we are, for example, getting a mobile phone for 10,000, for example, but you know that if one firm want to produce only 100 units of 100 units of mobile, for example, then you know that the unit cost is going to be, because by just in order to produce 100 units, they need large investment, and then the unit cost won't be the average cost, that the price they cannot sell it at the market at the 10,000. But what if they produce millions of units, different models and all, then because of that there is economies of scale, and then the unit cost will be reducing. So that means the percentage change in cost from percentage change in outputs, you can see that if it is greater than 1, you can see there is economies of scale. Right. So because that is 1, then economies of scale is 1, that would often further lead to economies of scope as well. Then let us connect this one to our financial marks context. So then the question here is that how does it leads to conflict of interest? How economies of scope leads to a conflict of interest, and let us see what is conflict of interest before we are discussing that in detail. What kind of conflicts of interest prevalent in financial market? Let us see what is conflict of interest here. So conflict of interest arises when a financial service provider or an agent within such a service provider has multiple interests, which create incentives to act in such a way as to misuse or conceal information needed for the effective functioning of financial market. So that means concealing information or misusing the information which they are aware, and engaging in some kind of malpractice. Maybe they are incentivized to do that. That would often lead to adversely affect the effective functioning of financial markets, and that will deepen, that will further aggravate the problem of asymmetric information, that will aggravate the problem of asymmetric information. So when an institution provides multiple financial services, thereby creating an opportunity for exploiting the synergies or economies of scope by inappropriately diverting some of their benefits, then this would adversely affect the working of the finance market. So because of the multiple objectives which I mentioned, for example, same firm starting multiple business, bank for example starting insurance firm, starting its own consultancy businesses, and sometimes the banks, so many banks join together, and what if they start setting up a rating agency, credit rating agency. So all these actually, you know, that sometime they will be rating some of the products of its own, that means the own banks, the bank's own products, they will be rating their own products, their parent company's products. So that all actually going to create some it adversely affects the efficient working of the financial market. So because of these multiple objects, conflict between these objectives happen. Right. So someone is, for example, credit rating agency, they have the credit rating agency. At the same time, they are also in the investment banking, they are also in the consultancy business. So because of these multiple objectives, there is going to be conflict. So when multiple services they provide, there is potentially competing interests, and you know that obviously ultimately they want to maximize this profit, because they are all firms, at the end of the day they are all firms, they want to maximize their profit, and they have to satisfy their shareholders, and accordingly they will be working. So all this, as I mentioned just previously, may lead to conceal information or disseminate misleading information in the financial market. So why do we care conflict of interest? Then you know that this actually reducing the quality of information in finance market. This will aggravate the problem of asymmetric information. Then ultimately what is going to happen, that the concept that we discussed in the previous session, that means symmetric information will create adverse selection problem and moral hazard problem. That all would lead to prevent channeling funds into the most productive uses. Let's now discuss what are the major sources of conflict of interest in the finance markets. So there are large areas, several areas of financial activities with a combination of other activities which all lead to conflict of interest. However, for the sake of simplicity and to manage our discussion, let us classify all these broadly into 4 areas of financial activities that is actually the more prominent, relevant in the financial market, and let us discuss this one by one. So one area is with the investment banking, when they engage in both research and underwriting, then these lead to conflict of interest. And the second is auditing firms, because we have seen that most government, in order to ensure a sound financial system, in order to reduce the asymmetric information problem, most countries, actually the government ask the firms to get their balance sheet get audited by independent firms, right? And however, the auditing firms sometimes they also have consulting business as well. So auditing firms, they, because of the economies of scope, they also engage in consulting as well. So this actually create further conflict of interest. Then the third one, rating agencies. The credit rating agencies, their primary duty is to do credit assessment, and they also do consulting. Why they do? Because they have lots of information. Because how do they do credit assessment? Because they collect lots of information about the default risk, about the economic fundamentals of each and every firm whom they are going to do the for those products, that debt products or IPO that they are going to do, debt products instrument that they are going to do the credit assessment. So because of that process they are getting lots of information, they are investing lots of labor and technical managerial expertise they are utilizing in order to collect lots of information, and because of that actually they have lots of this capacity that the managerial and information they are managerial and technical capacities, and based on that they also engage in consulting as well. Then the third area is universal banking. What if the same bank engage in commercial banking activity, investment activity and insurance company? They set up the, so one bank, the parent bank set up, they have the commercial bank, investment bank and insurance companies. So what we are going to do, see here that because of all these the conflict of interest, this would lead to financial crisis, and clearly to showcase all this how conflict of interest really lead to financial crisis, the 2007-8 financial crisis is one of the classic example of how a conflict of interest led to this financial crisis of 2007-8. And actually when we study 2007-8 crisis, actually we are going to review all these points what we are going to discuss here. That means that actually the conflict of interest played a major role in the 2007-8 crisis, financial crisis. Let us now discuss one by one what are the areas of conflict of interest and how does it affect, what are the possible way it affects the working of financial system. So one area of a conflict of interest is in investment banking. What if when investment banker engage in both research and underwriting? So investment banks, because of their huge vast managerial and technical expertise, they often engage in two tasks. One is research to companies issuing securities. That means one is actually research, we can also say that consultancy also little bit we can say. Second one is underwrite these securities. So the information synergies from underwriting, research and market making provide a rationale for combining these distinct financial services. This combination of activities leads to conflict of interest, however. So the conflict of interest that raises the greatest concern occurs between underwriting and brokerage, where investment banks are serving two client groups. One is issuing firms and the other one is investors. See, look at, there are actually serving two client groups. Actually both of them are on the opposite side, actually in the both side of the market. Actually one is the who is issuing these securities, and the other one they also do give services to the investors. So issuers benefit from optimistic research. So the firm who is issuing a security is expected to benefit from the research output that they are getting from their client, the client, that means from the research companies, while investors desire, what the investors, if you are a lender, you will be expecting an unbiased research. So if the incentives for these two activities are not appropriately aligned, and there will be a temptation for employees on one side of the firm to distort information to the advantage of their clients and the profit their department. So you can see here that when the same firm, the investment banks underwrite. What is underwriting means? Underwriting means an individual or an institution undertakes the risk associated with a venture. That means an investment or a loan in lieu of a premium. So in the securities market, for example, underwriting involves determining the risk and price of a particular security. That is, it's a process seen most during IPOs, wherein investment banks first buy or underwrite securities of the issuing entity, then sell them in the market. So this ensures that the issuers of the security can raise the full amount of capital while earning the underwriters a premium in return for the services. So, this actually, because as I mentioned here, they will be able to do when they are doing underwriting. At the same time, we also see that they do the research, provide research services, and they combine tasks because of information synergies. So, in this case, you know what is going to happen. So, the information produced for one task may also be useful for the other, that is the economies of scope, right. So, the research, the output they are having, they also will be using it for underwriting these securities. However, the brokerage that they are getting, the brokerage that they will be getting by providing research services, consultancy, these services to the companies, at the same time as an underwriter, what is the benefit that they are getting. Sometimes there will be, maybe one area maybe they will be benefiting more, the return from brokerage may be large as compared to underwriter, or maybe they sometimes feel that an underwriter, as an underwriter, sometimes they have the incentive to little bit tweak or manipulate the price. That means the for example, while issuing IPO, how much price, what is the unit price of the IPO, sometimes they have some incentive to bias it. So, brokerage versus underwrite, what if potential revenue from underwriting is greater than the brokerage commission? So, because if this happen, you know that there is strong incentive to alter information in favor of issuer of securities. So, they have strong incentive to alter information in favor of issuer of securities. Then this actually also, you see, this will be, they are actually doing it in a biased way. They are not actually for example, the securities price, what we expect that the price of securities, for example, the price of securities, it should be reflecting the economic fundamentals of that firm, not based on any other aspects. So, here let us see that what this, in order to get, for example, the research business or get the underwriting business, sometimes this firm they engage in some other malpractices, to say for example spinning. Spinning means investment bank may allocate the hot but underpriced IPOs to the executives of other firms to persuade them to get their firm's consulting business. To get their consulting business, what they will do, that when this investment bank, when they are underwriting any new securities or IPO, for issue a IPO of a new firm, another firm, suppose, then what they will do, that they will be giving some hot, that the IPO, that means newly issued share, that you can say, that they will be giving to the executive of the other firms. That means they are in a way a kind of bribing, indirectly we can say that a kind of bribing, so that the managers of that firm, the another firm who got these IPOs, have an incentive to approach, is incentive to hand over the consulting businesses of their firm to this investment bank who gave them these IPOs. Why it's called hot but underpriced IPOs? You know that when you get an IPO, very within 1 or 2 weeks it will be listed in a stock exchange, then obviously most often it happen that IPOs will be almost, it will be at par with the price in the secondary market, but obviously sometime when you get the IPO, it will be little bit underpriced, because the price will immediately, you will get a higher price within 1 or 2 weeks when the IPOs, these securities are listed in the stock market. So, this is in a way that spinning, this is in a way that they are bribing the executives of the other firms in order to get their consulting business. So, because of this, you know, executives of the firms, so what they will do, it actually, they will be doing a biased business. They will be approaching a firm, this firm, the investment banker, because they got benefited from them, they benefited from them by getting underpriced IPOs for their actually on a personal basis. So, this may not be right investment for the firm. So, the biased business, they will be giving this consulting business to this firm, right, to the same investment firm. So, this may not be the right investment for the bank for their firm, because this may raise the cost of borrowing and it diminish the efficiency of capital market. And maybe the same managers, they will be approaching the same investment bank for next time when they want to issue an IPO. right, underwriting. So at that time they will be approaching the same investment bank. So that means they shortlist or identify an investment bank not because of their any the economic consideration, but because of they have been benefited because of spinning. So without spinning, what I want to say here is that an efficient firm investment banker might have fetched a high value for the IPOs of the issuing company. So this will actually affect the efficient working of the finance market. Another area of conflict of interest is in the areas of accounting firms. What if an accounting firm engage in both auditing and consulting business? Let us discuss these in detail in the next section. Thank you.